Our cash distribution policy has led to a yield of 4 times the peer average since 2024. As I mentioned, these returns were accomplished through disciplined acquisitions on top of the best-in-class break-evens in both natural gas drilling and liquids-weighted peers. Post the start of the conflict in Iran, we moved from drilling 100% natural gas wells to crude-heavy drilling. This is the same type of pivot that we made in April of 2025 when post-tariff day, we changed our drilling plans from oil-weighted drilling to natural gas. This is the luxury of having nearly 3 million acres of land that's held by production. Currently, we're drilling our last 2 wells in the Mancos Shale. The completion phase of this year's drilling has been delayed until next year in order to stay within our internally mandated annual CapEx of 50% of operating cash flow. Given that restraint, it's more valuable for us to drill for oil rates of return versus natural gas in the last half of this year. We currently have 3 additional rigs running in Oklahoma. These are located in the Oswego, the Red Fork, and Ardmore Basin Sycamore. The Ardmore Basin locations will be completed by the end of Q3. We will defer drilling more Red Fork locations until the Q1 of 27 and keep 1 rig in the Oswego during Q4 of 26. Our drilling schedule is very fluid. One of our hallmarks is the ability to change the product we drill for and the amount we spend very quickly. MACH has a variable distribution to capture the changes in CapEx associated with different drilling patterns. The pattern in 2026 has been to spend more CapEx in Q2 and Q3 while drilling in the San Juan. The variable nature of our CapEx reveals itself in our distribution. This quarter, we will distribute 36 cents per unit. Since we do not have fixed distributions, there's not any pressure to spend more than 50% of our operating cash flow on CapEx. In other words, the cash flow dictates our pace of CapEx, not the lust for growth at any cost. The clear workhorse, as far as CapEx in our portfolio, has been the Oswego Limestone Formation in Kingfisher County, Oklahoma. We have drilled more than 250 wells on this asset since 2021, and recently moved a rig back in the area to continue drilling once oil prices improved. And we show in our presentation the Oswego carries a rate of return of 87% at a $75 oil strip. The key to the formation is not how much we find, but in how much we spend. We're only looking for approximately 160,000 barrels of oil, but we'll spend only $3.3 million to drill and complete. Cutting costs is the key to our business model. The newest field we have acquired that will also become a drilling workhorse is the Mancos Shale of the San Juan Basin. Within the San Juan, we now hold 575,000 acres of land that only expires when production ceases. The key zone to elaborate on is the Mancos Shale. This zone is just now being expanded. Our Mancos Shale position represents one of the most compelling emerging natural gas opportunities in North America. The well performance rivals that of the better-known Haynesville and Marcellus shale plays, with operators recently reporting Mancos initial production rates exceeding 25 million cubic feet of gas per day. The Mancos footprint is approximately one-third the size of the Marcellus and 1/10 the size of the Haynesville. However, MACH controls the play with only 3 other sizable owners. We are the second largest producer of natural gas behind Hillcorp and also the second largest owner of acreage. The play has increased more than 20-fold in the last 5 years and now exceeds 500 million cubic feet of gas a day. The San Juan also benefits from a mature natural gas transportation network developed over decades of conventional gas production. We expect over the next 5 years that additional takeaway capacity will be installed to get to premium gas markets of Arizona and the Pacific Coast LNG markets. This is much different than when the Marcellus and Haynesville were first being explored and there was no takeaway available, which required operators to take on large firm commitments with pipeline companies. We currently have a gas marketing agreement in place through 2030. Therefore, by the time the contract amortizes in 2030, we'll have strategic optionality for our 350 million cubic feet of natural gas that can be held flat by drilling only 5 net wells per year. If we choose to increase activity to 10 net wells per year, we could grow MACH's net production to more than 500 million cubic feet of gas per day. This is the benefit of buying low decline, cash flowing assets that also have fantastic upside potential. The Mancos show us has potential to dominate the MACH story in the years to come. As in the Oswego, the key to increasing rates of return in the Mancos is to lower cost. We believe that we could lower capex of a 3-mile lateral from nearly $20 million to less than $15 million per well. Now that our drilling season is underway and we have 4 locations drilled, we expect the ongoing program to be in the $13 million range for a completed well. I'll now turn over the call to Kevin to discuss financial results.
Thanks, Tom. For the quarter, our production of 149,000 BOE per day was 15% oil, 69% natural gas, and 16% NGLs. Our average realized prices were $95.40 per barrel of oil, $1.93 per MCF of gas, and $28.99 per barrel of NGLs. Of the $360 million total oil and gas revenues, the relative contribution for oil was 54%, 30% for gas, and 16% for NGLs. On the expense side, our lease operating expense was $98 million, or $7.21 per BOE. Cash G&A was approximately $7 million, or 54 cents per BOE. We ended the quarter with $41 million in cash and $270 million of availability under the credit facility. Total revenues, including our hedges and midstream activities, totaled $406 million, adjusted EBITDA of $182 million, and $154 million of operating cash flow. And our development capex for the quarter was $97 million, or 63% of operating cash flow. Year to date, our development capex is right on top of 50% of our year-to-date operating cash flow. In the quarter, we generated $60 million of cash available for distribution, resulting in a distribution of 36 cents per unit, which will be paid on August 31st to holders of record on August 17th. Daryl, I'll now turn the call back to you to open the line for questions.
Thank you. We'll now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for your questions. Our first questions come from the line of Neal Dingmann with William Blair. Please proceed with your questions.
Morning, Tom and team. Thanks for the details. Tom, my first question is just on your upcoming, as you've kind of been moving the upcoming overall drilling program. Can you remind me, I think is just double checking, most of your near-term D&C focus will be on the Oswego, and if so, could you just remind us, how much activity that will consist of and how you're thinking about the economics behind this play in this environment?
Yeah, Neal, you're correct. The ongoing drilling program that we have through Q4 of this year is to keep an Oswego rig running. We have a lot of locations. The Sycamore locations in southern Oklahoma are the highest rates of return we have, but there's really only 3 of those left that we picked up through a couple of acquisitions in 2024. So the Oswego continues to be, as I mentioned, the workhorse of our program, and we'll keep a rig depending on pricing, but keep a rig there through 2027 also. So kind of a consistent rig running in the Oswego. If prices stay as they are, we'll move a rig back into the Red Fork next year. And that play has a little bit more running room with this also. So those are kind of the 2 oil plays. We're yet to know where gas prices will be next year, but we do plan to have a program in the Mancos Shale to drill and then complete the wells this year, assuming that gas prices are rebounding by next summer.
Tom, does that Oswego compete, with other more well-known oily plays in this kind of environment?
Oh, you'd have to tell me. We have basically an 85% rate of return at $75 oil, so I think so.
Got it. And then if I could, just on capital allocation, could you remind me, you or Kevin, just on, broad terms, what around your reinvestment rate, and then how you intend to deploy the remainder of the cash flow. I think it's pretty straightforward what you all are doing.
Yeah, Neil, we, as said in this prepared remarks, we were right on top of 50% year to date. And, that's one of our pillars to have that reinvestment rate of 50%. So we would expect to end the year at a similar number. I mean, it may have a little lumpiness quarter to quarter, but not much.
And Neil,
very good. Thank you.
The operating cash flow drives what our CapEx is. So we're going to stay under 50% of operating cash flow. So as you can see, quarter to quarter, we'll either increase CapEx or decrease CapEx depending on what operating cash flow is or prices.
Thank you all.
Thanks.
Thank you. Our next questions come from the line of Charles Meade with Johnson Rice. Please proceed with your questions.
Yes, good morning, Tom and Kevin, and to the rest of the MACH team there. Tom, I'd like to pick up on that last point. Assuming you had the operating cash flow to do the Mancos completions whenever you wanted, what is the price that you need to see in the San Juan Basin market for you to pull the trigger and do those completions?
Oh, it's not so much that we wouldn't do the completions. It's probably more that we wouldn't spend any CapEx if prices continued to be under $3. I think it would be difficult to have any gas program in the U.S. Working. So if you think of kind of the BCF per thousand that we see in the Mancos, it sits just under the Marcellus. I think we calculate the Marcellus at 1.9 BCF per thousand feet. The Mancos at 1.7 and the Haynesville at 1.6. So if you're all three of those are going to be in line with the same types of production. The San Juan as its difficulties of basis at times, but then other times it has very good basis. Like today, it sits on top of the Mid-Con. So I think that to have an ongoing drilling program for natural gas that competes with oil, so that our problem is that we only have a certain amount of operating cash flow, and that goes to the highest rates of return. And so going into next year, what we have to look at is if the Mancos can compete against our oil reservoirs, and we won't know that really until after we get through this winter. As you know, Charles, I'm a little hesitant right now to be bullish natural gas, but as we come into full storage, but into the fall and are looking straight in the face of a strong El Nino winter, that it's difficult to be real bullish about it. But so we'll just evaluate as the year goes into next year. I'm still I think most people are very bullish long-term natural gas. It's just how to get from here to there. And that's basically, it might be a next summer event before we really do much spending on natural gas CapEx.
Right. Tom,
as I look out over the longer term period of 5 years, and you take that looking at with our gas contract that we bought, amortizing that hedge out through 2030, we should be in perfect position to capture the demand that everyone sees coming. And I don't think Western supply is going to keep up with that, and so that ultimately I feel very good about our natural gas positions. It's just how much we spend in 27 might fluctuate.
Right, Tom. I appreciate your comments. You can be a natural gas bull, but at the same time be honest about what the next few months look like. Second question. I wanted to ask about the Central Basin Platform. I actually heard from another company recently about a so-called BMW play, Barnett, Mississippi, and Woodford in the Central Basin Platform. And I don't think it's your style to go be a pioneer on a play like that, but I'm curious if you're aware of it, if it's happening near some of your acreage, perhaps in Gaines and Andrews.
I'm not aware of it, and I don't believe it's near any of our properties. And we're having any trouble even getting a Clear Fork location cleared, so I don't think we'll be doing the BMI.
All right, thank you, Tom.
Thank you.
Thank you. Our next questions come from the line of Michael Scialla with Stephens. Please proceed with your questions.
Good morning, guys. I want to start with that your last comment there, Tom, on the Clear Fork. What are the plans there now?
Well, we don't have it in our drilling schedule yet. So right now, the Clear Forks, again, we were planning on it earlier in the year when we thought we'd add another rig, but as prices moved away from where they were, the Clear Fork was the first to be exited. So as of right now, we might get the locations in 2027. It's just really more price dependent again, where our operating cash flow is. I mean, the luxury we have is we sit around on 3 million acres of land that's HBP, and we can pick and choose where we want to drill at the highest rates of return. And so it's just, I realize from being an analyst, it's hard to keep track of what we're trying to do, but it really can change month to month. Ask Kent; he has to model it every month.
I feel his pain. I guess just to get a little bit more color on the Clear Fork, it sounds like it doesn't compete today with the Oswego. Can you just describe what the opportunity set is there? What's the inventory like? And would they be vertical wells? Is it under water flood? Can you just give us a little bit more color on it?
It is under a water flood, but we drill horizontal wells within a water flood, and I can kind of tell you. So and then there's only like 8 locations, so it's not hundreds of locations. So we pick and choose around what we have, and when we buy additional land that comes up, it just happens to have some locations that can be drilled on it. I guess if it all worked well, do you know how many rig that we've got? It's 7 wells. For next year, if it comes into the program. So like at the end of July, that's going to have a 53% rate of return compared to the Oswego in the 80s. So just if I had more operating cash flow, we'd drill it. That's kind of where the point is, I guess. It is a target worthy of drilling. It's just that we're going to stay below 50% of operating cash flow.
Understood. I wanted to ask on the balance sheet. I think last quarter you said you kind of anticipate, as you move forward, leverage will move down naturally, just given especially where oil prices are. But still feeling that way, or do you feel compelled to pull back at all on the distribution, or to do anything differently than what you're planning or have been planning historically?
Yeah, I mean, I think 2027 is a year that we need to get our leverage down, and I think our board is on board with that. So it's just basically we recognize that we are running a company today that at today's prices, looking at the end of the year, is 1.4 times levered, and we want to be at 1 times leverage. And if you think about that, the reason that we want to be at or below a turn of leverage is because we never know when something's going to happen. Like, in the next few months, it might be a really good time to be buying a natural gas asset. Well, I'd like to have our leverage back down to a point that we can use some debt to make a purchase before bringing that leverage back down through the equity market. So, yeah, we want to be at a point that we're less levered. So as I mentioned, we have an ATM program that doesn't really affect our trading, that will lower our leverage. We can always cut our distribution some. We did that in 2024, I believe, or was it 2025? 2024, where we amortized some of our distribution to pay down debt. Let's just say it's a focal point that I've talked about it now for nearly a year, I guess, 3 quarters, and our leverage hasn't moved down yet. And so that it's just time for us to get started here soon. If we don't, what I'd love to do is find an acquisition that we could buy using equity, but there's just a lot of capital chasing a few deals right now.
We'll stay tuned on that. Thanks, Tom.
Thank you.
Thank you. Our next questions come from the line of Derek Whitfield with Texas Capital. Please proceed with your questions.
Good morning, Tom and team, and thanks for your time.
You bet.
Wanted to circle back on your earlier comments on natural gas as you see it today. While I realize you can't provide 2027 guidance, we and most of the street likely have elevated gas-weighted CapEx for 2027, which inherently depresses your CAD at current strip. And I think what we're all grappling with is how to manage activity as the current pivot favors oil-weighted activity and production into 2027. As we sit here today, should we think about higher activity in oil through the first half and some degree of shift to gas in the second half as a starting point? I mean, you clearly have the flexibility, as you noted today, to lean into oil or gas, but just that's kind of what we're grappling with.
Yeah, I think that's fair. So I think that basically we don't have the activity in our gas asset next year will be the Mancos. So the activity would be that if we choose to spend money in 27 on natural gas, which right now we would plan on it, just assuming that prices pick up into the summertime, that we'd start our completion program sometime in late spring or the springtime, and then have a drilling program through the summer, and then complete all those wells come in line with each other.
Yeah, that makes sense. And
Derek, so we haven't really worked on a 27 program yet. It's something that we're starting to work on now. So I think obviously by our next quarter call, we'll have a better understanding of where we plan to have our CapEx. And we aren't as easy to follow just because we can change both the amount we spend and on what asset we spend it on, and it can happen very quickly. And so I do understand, but in every time that we make a change, it's for a higher rate of return.
Understood completely. And we also appreciate that we can make changes in 5 minutes where it's going to take you guys quite a bit longer with the actual plans themselves. So we appreciate it, again, just trying to kind of work through that, because at the end of the day, we should be solving for higher CAD. It just means it might counter, depending on where we are with oil and gas at any point in time. But maybe staying on gas, but going down a different path. With the addition of several large pipelines in the Permian, including the Hugh Brinson and Blackcomb this year, how are you guys thinking about the outlook for San Juan basis going into next year?
Yeah, I'm scared of San Juan basis right now. Luckily, we're fairly well hedged with our San Juan gas, but it's as we go into right now, we're sitting San Juan and Mid-Con are sitting 20 cents under the hub. It just seems pretty tight. So I don't know where San Juan basis goes in the near term. I do believe that over a longer period of time, that everything opens up. There's the Greenview pipeline that's being brought on by Tallgrass. That's going to give us 2.5 BCF a day. I think that's what they're projecting to the Arizona and Pacific Coast LNG markets coming in. They project 29 or 30. I think that might be fast tracked as demand is picking up. So I think over time the San Juan is going to be the key place for us. It's just where we have to watch carefully what pricing is in order for our capex in the meantime. But as we just mentioned, in order to keep our production flat there, we only need 5 wells. So it is a tremendous amount of capital to keep our production flat, or it isn't the end of the world if we let it decline if we're increasing our oil production at a higher price in other places. So we're going to be very flexible depending on what price gives us.
Great. Thanks for your time.
Thanks, Derek.
Thank you. Our next questions come from the line of Jeff Grampp with Northland Capital Markets. Please proceed with your questions.
Hey,
Jeff. Thanks for the time. Tom, your comments on the Mancos well costs I thought were really interesting. I think you mentioned, $20 million historically. You guys think you can get down to 13 on this recent batch. And I know in the past you talked about adjusting the completion design was a key lever there, but it seems like there's a lot going on to get that kind of reduction. So I was just hoping to better understand what you guys are seeing there to drive that kind of cost improvement.
Yeah, it's really more just getting services, having a different type, so like using wet sand versus dry sand, having being comfortable with a couple thousand pounds per foot of frac, which we used last year, and it works perfectly fine. Learning a few drilling techniques. Rick could do a lot better job than me explaining. All I could do is look at the results and see that we're going to be closer to 13 million than the 15 we projected and the 20 million historically. So it's to me the Mancos is much like the Haynesville. Is that the Haynesville started out with very high well costs, and over time, in their core area, they were able to bring those down and ultimately make the field have a rate of return. And that's basically the story of the Mancos. We started out with incredibly high well costs in the field that are now being brought down. Rick, do you want to mention anything about how costs are coming?
Yeah, as far as service costs, they're still in line, but we're optimizing our drilling performance and being able to get reduced overall days drilling is the main thing we've been able to change. But bringing some new vendors in obviously has helped reduce cost as well.
Yeah, our savings have basically been both on drilling and completion, but the completion costs have really come down.
Got it. I appreciate those details. And for my follow-up, given kind of the pace of development that you're laying out, Tom, obviously focused on the oil side, assuming that kind of program remains static, would you guys anticipate oil production growth in 27? Is this more kind of a maintenance level of capital that we're at there? Just trying to kind of triangulate where oil might go over the next, handful of quarters.
Yeah, I think it's difficult for us to have too much growth in any of our products because basically we're only spending 50% of our cash flow to keep our production flattish. I think that overall it's easier to grow a natural gas stream, especially if you're drilling 25 or 30 million a day Mancos wells. But I'd say our projection into 27 is basically keeping it flat.
Okay, great. I appreciate the details. Thanks, guys.
Thank you.
Thank you. Our next questions come from the line of Tim Rezvan with KeyBanc Capital Markets. Please proceed with your questions.
Good morning, everybody. Thank you for taking our questions. I just wanted to go back to the balance sheet. I just had one here. Tom, we see the same thing in our model that you do in yours, at around 1.4 times at year end. We do see sort of it kind of grinding down if you think about strip pricing into 2027, kind of near spitting distance of 1 times at the end of the year. So my question is, if it's such a pressing concern, and I appreciate you being candid about that, are you looking at asset sales? You have a vast acreage footprint. Are you looking at other things like, getting someone to sort of farm into your acreage or some sort of carry? Just kind of curious kind of how broadly you're thinking about options to accelerate that deleveraging.
Yeah. So, I mean, the selling assets are difficult because you're losing cash flow. And if you're, let's just say you're a little uh, not caring for the gas market in the near term, I hate to get rid of low decline gas assets whenever I believe higher gas prices around the corner. And so and you really don't want to be selling your high priced oil assets either. So to me, it's difficult to sell assets to manage for it, especially when we want to keep our declines low. Let's see, the second part of your question was what else were we thinking about? So that was the sell assets. What was your other question for the point of it?
I would just ask, are you looking to kind of, get someone to farm into acreage, get some sort of carry, yeah.
Yeah, I'm with you now. So the problem with selling acreage is that you'd love to say it's non-core, but every acre we have today was non-core when we bought it. And yet if you look at our results, you see that we're in the top of the peers for gas and oil. And so if you look at any well that we've drilled since inception of the company, we didn't pay for. So that was by definition a non-core acre. And so whenever we plan to go sell a bunch of non-core acreage, you might be selling the next best field. So and as as Charles mentioned, we're not going to be the guy who goes out and drills the wildcat, but we're going to have 3 million acres kind of hanging around to look at whenever somebody else does. And so today we have a lot of different companies. Mubrin especially is opening up areas that no one would have ever believed in the Mid-Con just a couple of years ago. You have Continental that stretches all the way from western Oklahoma to southern Oklahoma, drilling very good wells. And now the Diversified has the Camino asset, and it just a lot of activity with Flywheel and others in the Mid-Con that are developing acreage that if you would have asked me last year, we'd say it was non-core, and if we were in that mode of selling it, we'd have given away the ability to have the high rates of return we do today. So that's a long-winded way to say I don't really like to sell acreage either. And so that selling away your assets to me is not as efficient as if we were to cut a distribution a little.
Okay. I guess there's trade-offs to everything, but okay. I appreciate that response. Thank you. That's all I had.
Thank you.
Thank you, ladies and gentlemen. We have reached the end of our question and answer session. And with that, I would like to bring the call to a close. We appreciate your participation today. You may disconnect your lines at this time.